Welcome back. I want to take a little time to talk about the inverted yield curve because the shape of the yield curve seems to be changing lately. And this could represent a pretty significant development in the financial markets. The green line over here represents a 10-year bond that currently pays a 3.69% yield. The blue line is the 1-year bond that's at a 4.64% yield, and the yellow line is the 6-month bond that's at a 4.7% yield. Now, notice the 1 year and 6-month bond are both paying a higher percentage than the 10-year bond. Now, normally, in a quote unquote normal economic condition, the longer term maturity bonds, like the 10-year bond, pays a higher yield. But what we have right now are the shorter term bonds, like the 1 month or the 1 year and the 6-month bonds, that are paying a higher yield. And that, by definition, is an inverted yield curve. However, we can see that as of late, the 10-year bond yield has begun to rise while the 1-year bond and the 6-month bond have remained relatively flat. And this contraction in the yield, the difference between these two, is really something that could be very significant. Going back to the year 2000, we can see the purple line is a 10-year bond, the green line is a 1-year bond. The purple line, the 10-year bond, was above the green, and the black line, by the way, is the S&P 500. So as the stock market was going up in the year 2000, the purple line, the 10-year bond, was above the green. That's a normal condition. However, notice then the green line, the 1-year bond, traveled above. That was the beginning of the inversion, the inverted yield curve. That lasted for quite some time, and then eventually we see both bond yields start to move very much to the downside, but especially the 1-year bond, the green line, really fell and crossed back below the purple line. That marked the end of the inverted yield curve and the beginning of the 2001 recession. This happened about January of 2001. And of course, we can see the stock market plummeted after that. The signal of the beginning of this stock market crash was when the 1-year bond crossed back below the purple line, the 10-year bonds. We can also see the same pattern emerged in the year 2007. The black line represents the S&P 500. The red line is a 10-year bond. The blue line is a 1-year bond. Now, initially in the year 2006, the 10 was above the 1, and then the blue line, the 1-year, crossed above. And that was the inverted yield curve. But eventually, specifically around August of 2007, the blue line, the 1-year bond, crossed back below the red line, the 10-year bond. The inverted bond ended. And then shortly after that, we saw the beginning of the 2008 financial recession. And we see the 1-year bond, the blue line, really plummeted much, much further down than the red line did. And that occurred simultaneously with that stock market crash in 2008. We fast forward to present day, and we see the green line's a 10-year bond. We are in an inverted yield curve. But what's happening now is the spread between the two is starting to compress. The difference between the 10-year bond and the 1-year bond is starting to lessen, meaning the difference between the two is starting to shrink. Now, in the previous examples, we saw the inverted bond market ended with both bond yields going down. In the year 2000, both lines went down, and the 1-year bond, the green line, just went down faster. In the 2007 recession, 2008 recession, 2007 when it began, the blue line, the 1-year bond, moved down faster than the red line did. Now, in the current situation, we see here that the bond yield on the 10 years moving up and the 1-year bond is flat. This is a different situation because we're still under the premise that the Federal Reserve may continue, to raise interest rates. However, the fact that this bond spread is the inversion is compressing, the difference between the two yields is lessening. That indicates that we could see the beginning of the end of the inverted bond yield curve. A different way to look at it is as follows. The white line represents the spread between the 10 and 1 year bond. Now, the zero axis is all the way at the top. And notice at the lowest level, the spread was about negative 1.25%, meaning the difference between the 10-year bond and 1-year bond was 125 basis points. But now that has decreased. The spread is beginning to increase, meaning the inverted yield curve is lessening. If we see this line cross back above the zero level, that will mark the end of the inverted bond yields. In other words, if this green line travels up, or better yet, if the blue line, the 1-year bond, travels down below the green, that will mark the end of the inverted bond yield. Now, of course, history is not a guarantee of future results. However, we can see in the year 2000, when the inverted bond yield curve ended, that marked the beginning of the real stock market recession. Not the economic recession, but the stock market sell-off. In the year 2007, when the blue line, the 1-year bond, crossed below the red line, well, that marked the beginning of the stock market sell-off. So we're still very early, and there's no signal yet. However, we can see that the inverted bond yield curve inversion is beginning to decrease. And again, extremely early, but if we see the green line, the 10-year bond, cross back above, or better yet, if the blue line, the 1-year bond, crosses back below the green, that will look very similar to the beginning of the stock market sell-off that occurred in the year 2000 and 2007. Now, this could take weeks, months, or even years to develop. The inverted bond yield in the past, in the year 2000, persisted for quite some time, I believe around 9 months, if memory serves. In the year 2007, it was an even longer period of time. The inverted bond yield occurred in the middle part of 2006 and persisted all the way to the mid part of 2007. Actually, the latter part of 2007. So this could last anywhere between 9 to even maybe 18 months. So we're still very early in this process. But I thought it was kind of interesting to note the compression in the inverted yield curve and the implications if present trend does continue. We hope this has been helpful. We look forward to seeing you back soon.